All right, let's get right into it. Today, we are breaking down a really pivotal earnings call for legacy housing. That's ticker LEGH. And believe me, this call had it all. A huge earnings miss, a complete management shakeup, and a big new acquisition that the company is betting its future on. So let's dive in. We're kicking things off with this number right here, negative 39.7%. What is that? Well, that is the GAAP earnings per share surprise. A miss of this size, it tells you pretty much everything you need to know about why the market reacted the way it did, and it really sets the stage for all the drama that unfolded on the call. So let's get into the actual numbers for the third quarter. And to put it bluntly, this was a major disappointment. The results, well, they kind of speak for themselves. Okay, look at the scale of this miss. It's on both the top and the bottom line. GAAP EPS came in at just 35 cents. The street was looking for 58 cents. That's that almost 40% miss we just talked about. And revenue didn't do much better. It landed at about $40.5 million, which is more than $5 million short of what everyone was expecting, and it's down over 8% from last year. But here's a little twist in the story. Even though they sold fewer homes, the average price they got for each one actually went up by almost 8%. It jumped from $63,500 to $68,500. Now, what that tells you is that they were able to pass on some price hikes, and they successfully shifted their sales toward more expensive homes with more features. So you're thinking higher prices mean higher profits, right? Nope, not this time. And this slide just perfectly illustrates the core problem this quarter. Net income absolutely cratered by over 45%. It fell from almost $16 million last year all the way down to just $8.6 million. And the culprit? Severe margin compression. Their gross margin just collapsed, and it was crushed by higher material costs and, get this, tariffs on Chinese goods, which management said slapped an extra $1,200 onto the cost of every standard home. You know, management didn't try to sugarcoat it. The co-founder and executive chairman, Kurt Hodgson, he put it bluntly, basically spelling it out for everyone on the call. These terrible results directly led to a house cleaning in the C-suite just a few weeks before the announcement. The CEO, the CFO, and the general counsel, all gone. Okay, so the big question is, what now? With the original founders, Kurt Hodgson and Kenny Shipley, stepping back into the driver's seat, they laid out a pretty clear back-to-basics plan to try and stabilize the ship. Their game plan really boils down to three things. First, the leadership reset itself, right? The guys who built the company are back at the helm. Second, an aggressive attack on costs. Their general business expenses, what we call SG&A, they ballooned by over 20%, and management promised an immediate reversal of that trend. And third, a big strategic acquisition that's designed to kickstart their direct-to-consumer retail strategy. Let's dig into that acquisition a little bit. They bought a company called AmeriCasa Solutions for about $22 million in cash. But this isn't just about buying another dealership. They're getting a top-performing location in Houston, a portfolio of high-yield loans, a service center, and maybe most importantly, an AI-powered sales platform called FutureHomeX. So what's the big idea here? It's pretty clear. Use this tech to finally crack the code on running their own retail stores and capture those much, much higher profit margins. So when you step back and you look at everything, the bad results, the new management, the new strategy, you're left with two totally different ways to see this company. And this is really where the bulls and the bears are going to fight it out. On one side, you've got management's story. They're saying, hey, these margin pressures are temporary, that a big industry trade show filled their order book for the next 6 months, and this AmeriCasa deal is a real game changer. But then you have the market's take, which is focused on the huge risk in pulling off this turnaround, the governance issues from all the turnover, and just the cold, hard reality of that margin collapse. Legacy has officially become a show-me story. So how did the market vote on the day of the call? Decisively negative. The stock dropped 6% and trading volume spiked by 66%. Basically, investors heard the turnaround plan, but they sold the execution risk. And the Wall Street analysts who cover the stock, they pretty much felt the same way. B. Riley kept its neutral rating, but they slashed their price target from $26 down to $21, pointing to all the uncertainty. Other analysts just highlighted the huge miss and called the whole story mixed. You know, a balance of short-term pain versus long-term potential. Which, of course, brings us to our take. What are we at Talk Tickers watching for as we head into the next quarter? And where do we think this stock is going? You know, this is the million-dollar question for investors right now. The stock is trading right around its book value per share, nearly $22. So is this a classic value trap where things just keep getting worse? Or is it a deep value opportunity with a rock-solid balance sheet putting a floor under the stock while this turnaround story plays out? Okay, so based on what management said, here are our key predictions for Q4. We think they'll hit their production target of 8 to 10 floors per day thanks to that strong order book. We'll be watching their costs very closely. We expect SG&A as a percentage of sales to drop by about 2% as their cost-cutting kicks in. And we see gross margins starting a slow climb back to around 22.5% as price increases start to stick and cost pressures hopefully ease up. So, taking all of that into account, we are initiating our coverage here at Talk Tickers on legacy housing with a rating of market perform. So, let's break down why. On the plus side, the founders who built this company from the ground up are back in charge. The company's book value is still growing, and its balance sheet is a fortress. They have zero debt on their credit line. But the risks are very real. The company has a spotty track record on execution. We don't know how quickly those margins will recover, and there's a big risk that this AmeriCasa deal doesn't go as smoothly as planned. The potential upside is pretty well balanced by the risk. All right, now for our final segment, we're going to put on our hedge fund analyst hat and pitch a more unconventional trade idea for you. And this idea is built around a concept called a sum of the parts valuation, or SOTP for short. All it really means is you value a company by breaking it up into its different business segments: manufacturing, financing, real estate, and you value each one by itself. You do this to see if all the parts, added up, are actually worth more than the company's current stock price. So here's the trade. The thesis is that the market is only valuing legacy as a boring, low-margin manufacturer, and it's completely ignoring two really valuable hidden assets: its high-yield loan portfolio and its significant real estate holdings. So the play is to own the stock down here near its book value, and then wait for some kind of catalyst that forces the market to recognize that hidden value. What could that catalyst be? Well, maybe they sell off some of their extra land, management thinks that could unlock millions in gains, or maybe they spin off their profitable loan business. Or, best case, the AmeriCasa integration is a huge success, proving their high-margin retail model works and forcing a total re-rating of the entire company. And that wraps up our breakdown of legacy housing's very pivotal quarter. Look, this company is at a crossroads, and the next few quarters are going to tell us everything. We'll see if the founders can really bring it back to basics, or if this is just the start of a much longer decline. And as always, this is not financial advice.